Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. I'd like to welcome you to Next Level Charting. This is the show that is designed to take your charting to the next level. I'm glad you could join us. You can watch this show every Thursday at noon Eastern Time on StockCharts TV. You can also watch it on demand on YouTube. And if you're watching on YouTube and you like this video, please give us a thumbs up. So we're going to do something a little bit different today. We started doing these videos in January, early January, and I want to go back and look at some of the themes that have been developing in January and early February and give you a little update on those. And then I want to show you the sector divergences we had in 2000 and 2007 and why we need to look at these big sectors to see if they're confirming new highs in the S&P 500. And the big sectors more or less are confirming the new highs in the S&P 500. So here are the videos that we have so far on the Next Level Charting show on StockCharts. This is from the YouTube channel. You got the challenge for 2020, which basically is focusing on price and the price charts and forgetting about all the other issues, including coronavirus. You have the REIT SPDR beginning to turn around. That was the second video. Bonds started to turn around. And then I started talking about the chances of correction. And I showed ratio charts showing a decrease in the risk appetite. And then Amazon breaking out of a big bullish continuation pattern. And I highlighted the consumer discretionary ETF, the equal weight one. So I'm going to review some themes from these videos first. So the first show was the challenge for 2020, and then the second show is here on January 16th. This is a chart from XLRE REITs. We're noticing a bottom in REITs, and what you had here was one of my favorite setups. You had this long extended advance, and you're ripe for a correction. You deserve a correction. A correction is normal, and we got this falling wedge back to the rising 200-day moving average. And you can see the PPO 2200 was positive, even though it moved lower. It still stayed positive, which means the 20-day EMA stayed above the 200-day EMA. So the long-term trend was up. We had a normal correction, and we started to get that breakout at the end of December, and I highlighted that on Next Level Charting in the middle of January, and we've moved to new highs now. So we had a move, money moving into rate sensitive issues. And that was a theme that carried on the next week, because the very next week I highlighted TLT on the 23rd. So basically you had another big move advance, and you're entitled to a correction. And this one maybe overstayed its welcome, but it was a normal 38% pullback, a retracement of the big advance. You had this bullish engulfing week, and then we got the breakout there on the 23rd, roughly, with that big candlestick and move above that prior high. So bonds are in the midst of a breakout that signals a continuation of the bigger uptrend. We can see the trend was deemed up long-term because you can see RSI was in its bull range, which is from 40 to 80. It never broke below 40. And then the little trigger was the Stochh RSI move above 0.8. That was kind of like a momentum thrust, if you will. So that was the second theme. That was telling us the same thing as the first, which was that rate-sensitive issues were performing well, and that includes utilities. Now I'm going to highlight one more chart. This wasn't in the videos that I showed you, but it's something we've been following at Trend Investor Pro, and this is gold. Gold has been acting just like TLT, basically. You can see first there's the correction within the uptrend in the early part of 2019 and the breakout. And then we had another falling wedge correction and the breakout right around Christmas, and then consolidated a little bit and hitting a new high. So gold is one of the strongest assets since Christmas. it's been very strong and hitting a 52-week high. And it seems to be following this theme in that it is positively correlated with TLT. So then on January 30th, I put out a video talking about the excesses I was seeing in January and how that favored a correction. And I said corrections are like a box of chocolate. You never know what you're going to get. But you can see here that the S&P 500 ETF SPY bottomed a day later and moved to a new high. And we got a bounce in mid caps, but we did not get a new high. And we got a bounce in small caps, which was much weaker, a lower high formed, and it looks like small caps are turning down again. So this is still a theme that I think is possible right now, that we're still moving into some sort of a corrective mode. It could be a sideways trading range, or it could be a retracement of this big advance that we had from October to February there. So in keeping with the correction theme, on the next week, on February 6th, I highlighted some ratio charts that signaled a move to risk aversion, if you will. And we saw the riskier assets were starting to underperform, and the lower risk assets, low volatility assets, were starting to outperform. And the first ratio there is high beta relative to low volatility. And you can see it started moving down, and then it got that bounce as the S&P 500 moved to a new high. But overall, it's still moving down. This is still showing risk aversion. And then we got high beta relative to high quality. This is SPHB to SPHQ. And we can see a lower high as it turns down again. So we're still seeing risk aversion. And then we have the S&P 500 equal weight ETF relative to AGG bond, the bond ETF. And it underperformed in the in the latter part of January, and then outperformed in February, but is yet to exceed that high. And in the original video, I showed MTUM, the momentum ETF, relative to USMV, the minimum volatility ETF. And I decided to replace those because, as I noted in that video, I didn't like the way the components and the sector weightings were structured in the momentum ETF and the minimum volatility. They didn't seem to be that representative of momentum and minimum volatility. Go back and check out that video. In contrast, I think SPHB and SPLV capture the high beta momentum side relative to the low volatility, minimum volatility side better. So there are two more ratios that I was highlighting here, and that would be stocks relative to treasuries, and this is SPY relative to TLT. And we can see maybe a lower high is forming. Stocks are underperforming. And you can see this is junk bonds relative to treasuries, and this ratio does not look good at all. All right, it is turning back down and moving lower since the beginning of January. So I think 3 of the 5 ratios are clearly headed lower, and that tells me that there is some risk aversion in the market. So now I want to move to the principle of confirmation because we had new highs in the S&P 500 and the S&P 500 equal weight ETFs, and we also had several new highs in the sectors. And when you get a lot of sectors confirming new highs, that's bullish, and when you get sectors that don't, that's bearish. And so I'm going to look at the big sectors in the S&P 500 because I think they're the ones that are driving the index. Information technology, 25%. Healthcare around 14, financials 12.5, communication services and consumer discretionary around 10, and industrials bringing up the rear at around 9%. And I want to see how these sectors performed in 2000 when the market peaked and in 2007 when the market peaked. Now, of course, in 2000 and in 2007, we didn't have 6 big sectors. We only had 5 because communication services did not exist. It was pulled out of technology and consumer discretionary in 2015. So we're going to look at the big 5. And what we had in 2000 was 3 of the 5 forming lower highs. So there's SPY, and it's forming an equal high basically there in late August, early September 2000. And you can see that technology, a significantly lower high. It's just barely above its 200-day there. Consumer discretionary, a lower high and below its 200-day moving average. And then if I scroll down a little bit here, you can see we also had healthcare, just above its 200-day moving average and a significantly lower high. So it wasn't just technology that was peaking in 2000. It was two other sectors and three of the big five. Finance was doing fine, industrials are doing fine, but three of the five, the weight of the evidence was negative in September 2000. It was already foreshadowing the bear market. Now, if we look at 2007, the same thing happened. We had three of the five sectors with significantly lower highs at a time when the S&P 500 was hitting a new high. Sure, it's an incremental new high, but the S&P 500 hit a new high, driven by technology. XLK hit a new high as well there in October 2007. But consumer discretionary was below its 200-day moving average in October and forming a lower high, and it hit a 52-week low there in late October. Finance was below its 200-day moving average and forming a lower high, and it also hit a 52-week low there in October 2007. So clearly the warning signs were there with these two big sectors underperforming. And then the third one was healthcare. It formed a lower high, didn't get to that high. It was below its 200-day in November. Even though it did hold up, you can see we got deterioration later in industrials and continued deterioration in finance and consumer discretionary. And then technology did form a lower high ultimately. But we had a clear warning sign with big sectors deviating from what the S&P 500 was doing. So now we're going to add XLC to the mix and look at the big six sectors. So the S&P 500 hit a new high this week and last week as well. And you can see technology is doing just fine with new highs. XLY hit a new high. XLF hit a new high last week and is up a little this week. XLI fell back, but it did hit a new high last week. So we've got plenty of broad strength in the S&P 500 as far as these sectors are concerned. They are confirming. The only one that's not is XLV, but it's just a very slightly lower high and it's above the 200-day, so no big deal there. And XLC hitting a new high. So bottom line is the big six sectors, five at least, are clearly confirming the new high in the S&P 500. And I've just got a few seconds left, but I'll also do this for the equal weight sectors. The only one that is not confirming is consumer discretionary because it did not hit a new high and is still below the January high. But the other five did confirm with new highs, so we're seeing broad strength in the stock market. So thanks very much for tuning in to this edition of Next Level Charting. I'll be back again next Thursday at noon Eastern Time. And if you're watching on YouTube and you like this video, be sure and give us a thumbs up. Thanks very much for tuning in and have a great day.